Most of us grew up hearing that a bank is the safest place for money. That simple sentence feels reassuring and final, but it leaves out critical details nobody ever emphasized. If you felt a prickle of doubt just now, you are not alone because many people have the same question quietly. This video will untangle the comforting myth from the complicated reality with clear examples and practical steps. Belief in banks as absolute safety is cultural and psychological rather than technical. People equate the bank building and smiling teller with impenetrable security, without examining the terms and limits underneath. That faith influences big financial choices that matter over decades, affecting retirement, housing, and business decisions alike. If you want to make smarter choices, you need to understand the actual protections banks offer and their boundaries. The first layer of protection most people point to is FDIC insurance, and it is powerful but conditional. FDIC insurance guarantees deposits only up to specific limits, per depositor and per ownership category at each insured bank. That limit currently covers $250,000 for many account types, which protects most everyday savers. However, amounts above that limit are not automatically recovered in full if a bank fails, and that distinction matters. It is also crucial to know what FDIC insurance does not cover, so you avoid surprises. Investments like stocks, bonds, mutual funds, and cryptocurrencies kept at a bank are not protected by FDIC insurance if their value declines or the institution fails. Even account arrangements can change coverage amounts depending on ownership categories, such as joint accounts, trust accounts, and retirement accounts. Understanding these technical distinctions transforms the abstract idea of insurance into actionable planning decisions. Real people run into FDIC limits in predictable ways during times of growth or calamity. Families consolidating assets, business owners parking revenue, and couples saving for a house all end up with balances that can exceed single bank coverage. If your balances pass the insured threshold within the same ownership category at one bank, your unprotected funds could be at risk until the FDIC resolves the failure. That process can be slow and costly in both time and liquidity for depositors who relied on immediate access. Historical bank failures remind us that even big institutions can collapse and require intervention. During past crises, depositors sometimes faced temporary account freezes, delayed disbursements, or complex claims processes, despite eventual FDIC coverage for insured amounts. The headline names of old bank failures do not erase the personal trauma of people who could not access cash when they needed it. These examples show that institutional safety is layered and conditional rather than absolute and instantaneous. But banks are not only about failure risk. Inflation quietly erodes balances even when institutions are safe. When your savings grow slower than inflation, your purchasing power declines regardless of account security. This reality turns nominal safety into real-world vulnerability, because the numbers in your account can buy less over time. That slow bleed matters, especially for long-term goals like retirement and college funds. The math of inflation is simple and unforgiving when compounded over decades. A 2% inflation rate might feel small yearly, but it cuts purchasing power nearly in half over 30 years when left unchecked. Banks often offer interest rates on basic savings accounts that are lower than inflation, which means your real balance declines even while the nominal balance ticks upward. Recognizing that difference between nominal and real returns is essential for long-term financial planning. This brings us to opportunity cost, a concept everyone understands but few quantify accurately. Money parked in low-yield bank accounts misses the chance to earn higher returns in risk-bearing assets over long horizons. Those foregone gains matter because compounding favors returns that outpace inflation, especially for long-term goals like retirement. We must weigh the comfort of liquidity against the growth needed to meet future spending needs. So when exactly are banks not the safest option for your money in a practical sense? If you are saving for a decade or longer, keeping large amounts in non-interest-bearing or low-interest accounts can be unsafe in real purchasing power terms. Banks are also not the optimal place for uninsured large deposits. Business cash that needs protection beyond limits, or long-term growth objectives, where inflation and opportunity cost dominate. Recognizing the purpose of each dollar in your life helps determine the right vehicle for it. There are alternatives that provide different forms of safety and returns, and each comes with trade-offs. High-yield savings accounts and online banks often give better nominal rates while maintaining FDIC insurance for eligible accounts. Other options include certificates of deposit for predictable yields, treasury securities for government backing and inflation, protected instruments like I-bonds and TIPS. Riskier alternatives such as stocks, real estate, and cryptocurrencies can offer higher long-term growth, but introduce market volatility and different liquidity profiles. High-yield savings accounts can be a straightforward upgrade while keeping the institutional safety of FDIC insurance. Many online banks offer significantly higher yields than legacy brick and mortar banks because they have lower overhead costs. However, even the highest deposit rates can lag inflation during certain periods, and rate environments change over time. Treat these accounts as improved liquidity tools rather than the only place for long-term wealth building. Certificates of deposit, or CDs, provide predictable yields if you tolerate time commitments and early withdrawal penalties. Laddering CDs can smooth interest, rate risk, and create recurring liquidity points over multiple maturities. CDS remain FDIC, insured at eligible banks up to coverage limits, yet require discipline to avoid tapping funds during emergencies. For savers comfortable with time-based commitments, CDs can convert idle cash into a modestly higher, more predictable return. Treasury securities offer a kind of safety backed by the full faith of the government and come in short and long maturities. Treasury bills and notes can be liquid and competitive, especially for short-term parking of large sums. TIPS, or Treasury inflation, protected securities, directly adjust principal with inflation, offering a hedge against eroding purchasing power. For savers worried about inflation, Treasuries present a strong, low counterparty risk alternative to traditional bank deposits. Series I savings bonds are another interesting tool for inflation protection purchased through government portals. I-bonds combine a fixed rate with an inflation-adjusted component, which resets periodically to track consumer price changes. They do have purchase limits per person per year and restrictions on early redemption, which make them best suited for medium-term savings rather than immediate liquidity. For many individuals, I-bonds become a reliable complement to bank savings when inflation protection is the priority. If you hold investments in a brokerage account, know that SIPC protection differs fundamentally from FDIC insurance. SIPC protects against a broker-dealer's failure by restoring missing assets, but does not protect against market losses or asset devaluation. That means your stock or ETF positions can fall dramatically in value, even though the brokerage itself remains solvent or is made whole by SIPC. Understanding the distinction between counterparty or custodial failure protection and market risk prevents false comfort. Practical diversification within banking frameworks can extend your effective FDIC coverage quite sensibly. Spreading deposits across different ownership categories, different insured banks, and credible custodial structures can raise the total insured amount materially. Services like multi-bank networks and brokered CDs can consolidate administration while maintaining multiple bank coverage under the hood. These structural tools enable savers with larger balances to preserve safety without sacrificing manageability. To illustrate opportunity cost, consider a hypothetical scenario comparing cash versus conservative stock market exposure over decades. Historical averages of broad equity indexes show meaningful outperformance relative to basic bank yields, although past performance is not a guarantee of future results. What matters is not the headline return, but the difference between real growth and inflation, adjusted needs for future spending. Modeling scenarios, even conservative ones, helps you decide how much cash neutrality is worth versus potential growth. Behavioral biases drive a lot of the default trust we put in banks, and they are powerful influencers of financial outcomes. Humans are wired to fear immediate loss more than future missed gains, which favors cash preservation over growth opportunities. Acknowledging that bias allows you to design guardrails that counteract it, such as automated investing and rule-based allocations. With small process changes, you can capture growth opportunities while preserving the psychological security you need. That leads to a pragmatic strategy where banks play a clearly defined role rather than an exclusive one. Use bank accounts for emergency funds, daily liquidity, and automated bill flows, because banks are unrivaled for convenience and reliability in those functions. Then allocate surplus funds to instruments aligned with your time horizon and risk tolerance, such as treasury bills for near-term goals or diversified equities for long-term growth. By matching purpose to vehicle, you keep both safety and opportunity within your financial plan. A blended approach could look like a three-tiered savings ladder across different vehicles and durations. The first tier is an accessible cash buffer in 1 or 2 FDIC, insured accounts sized for 3 to 6 months of expenses. The second tier uses short-term government securities or laddered CDs to preserve capital while earning better yields. The third tier targets long-term growth through retirement accounts and diversified equity exposure for wealth accumulation over decades. Real account mechanics can create friction you should anticipate before moving large sums to a bank. Large deposits may be subject to hold policies, verification processes, and anti-money laundering reviews that delay availability for days or weeks. Withdrawal limits, daily transfer caps, and branch access issues can also complicate urgent needs even for insured funds. Knowing these operational constraints helps you structure liquidity in a way that prevents painful surprises. Let me tell a composite example of how limits become real in a crisis for clarity and instruction. Imagine a small business owner who keeps a 6-figure balance at a local bank because it pays convenience and a modest interest rate. When that bank faces trouble, account access can get disrupted even if insured limits ultimately protect some funds, leaving payroll and operations in jeopardy. That story underscores why diversification and contingency planning are not theoretical concepts, but practical necessities. There are regulatory tools and services that help extend protection if you understand how to use them. Nationwide deposit placement networks, brokered CDs, and multi-bank sweep arrangements let you spread large balances across dozens of institutions, while simplifying administration. These solutions are not magical, but they are pragmatic extensions of FDIC coverage for people with substantial deposit needs. Consulting a trusted advisor or your bank's deposit specialists can clarify which networked products fit your situation. A practical checklist makes this abstract conversation immediately useful for viewers who want to take action tonight. First, audit your current deposit concentrations and check each account ownership category against FDIC rules to know insured amounts. Second, decide on a target emergency fund size kept in liquid, insured accounts, and commit to a separate allocation for short-term goals. Third, route surplus into chosen alternatives and automate contributions to overcome behavioral biases over time. If you want to build a diversified savings strategy that withstands both bank failure and inflation, start with clear goals calibrated to time horizons. Long-term goals benefit from risk, bearing assets that historically outpace inflation, while short-term needs require liquidity and capital preservation. Allocate money accordingly and review at least annually to rebalance with changing rate environments and life events. Consistency and clarity about purpose outperform frantic attempts to time markets or chase fleeting yields. The philosophical twist here is that safety is relative and defined by your needs rather than a single institution. A bank can be the safest place in terms of custody and day-to-day reliability, but it can be an unsafe choice for long-term real purchasing power preservation. Understanding that nuance is an act of empowerment because it forces you to choose instruments that match real objectives. When institutions have limits, the safest option is often a diversified plan rather than a single, comforting location. Ultimately, banks remain essential pillars of modern finance, but they are not a universal solution for every financial need. Treat banks as one tool among many, optimized for liquidity and convenience, while using other vehicles to protect against inflation and grow wealth. If learning one thing from this video helps you sleep better at night, let it be this: safety is a design problem you can solve with knowledge and deliberate allocation. Build your plan, automate the process, and revisit your choices as life changes. If this reassessment of bank safety gave you a new perspective, consider taking 3 small steps right now. First, Check your insured balances and ownership categories to know where you stand without guessing. Second, set up an accessible emergency fund in insured accounts sized to your comfort and obligations. Then route excess savings toward appropriate alternatives. Third, subscribe to resources that help you implement automated savings and periodic reviews so ideas turn into sustained habits. This conversation is about control, not fear, because knowledge reduces the power of worst-case surprises. The banking system offers significant protections, but only if you know the limits and design your accounts with intent, instead of defaulting to convenience. If you want deeper walkthroughs of any specific alternative, like laddering CDS, setting up treasuries, or maximizing FDIC coverage across banks, tell us in the comments. We can make follow-up videos that take the technical steps and paperwork out of the picture for you. Before we go, remember that every financial decision carries trade-offs and context matters more than absolutes. Treating banks as a piece of a broader strategy gives you the best chance of preserving safety in the short term, while creating growth and inflation protection in the long term. If this gave you a new perspective and practical steps you can use, hit subscribe and ring the bell for deeper financial explainers. Your future self will thank you for learning the difference between nominal safety and real financial resilience.